Coffee is more than a morning ritual. In 2024, Brazil produced about 40% of global Arabica and Robusta unparalleled scale. That share means any disruption ripples through roasters, retailers, and even gas stations in distant markets. Rainfall patterns, aging trees, labor costs, and climate shifts converge to push prices higher when supply tightens. But the true cost travels beyond the bean. Farmers struggle with debt, cooperatives, and price volatility, while consumers face rising cups, corporate risk, and ESG scrutiny. The topic matters now because investors are reconsidering supply chain resilience and the role of essential commodities in a fragile global economy. Brazilian coffee production shapes the world market because the country grows nearly half of the world's Arabica beans and a growing share of Robusta. When crops fail or yield falls, futures rise and roasters pay more for beans shipped around the globe. Right now, weather patterns in Minas Gerais and São Paulo, plus aging trees and disease pressure, are squeezing supply even as demand climbs in Asia and Europe. Traders watch weather maps, soil moisture sensors, and crop reports to gauge harvest timing. In practical terms, a drought or frost can lift the cup price from ordinary to attentive consumer costs. To understand the true cost, we must trace Brazil from a coffee frontier to a global price influencer. The modern Brazil coffee story begins with colonial roots, mid-century expansion, and the establishment of vast estates that turned coffee into a national economic engine. The country weathered price booms and busts, including the 2014 drought that tightened supply and drew price spikes over several quarters. Farmers responded with new varieties, shade management, and improved logistics, but debt remained a perverse constant for smallholders. Coffee became a barometer for exchange rates, energy costs, and climate policy, entwining rural livelihoods with global market cycles. Markets have priced in Brazil as the global swing factor for coffee. ICE Arabica futures have traded in a tight range recently, widening when weather news hit and narrowing as harvests progress. The Brazilian real has moved with risk sentiment, amplifying price moves for importers who hedge in dollars. Roasters adjust contracts, bag sizes, and order horizons to manage volatility. Cafes and retailers face higher bean costs, which can compress margins unless price pass-through occurs. Meanwhile, funds and quant traders monitor weather data, farm gate yields, and crop forecasts as signals that supply constraints may persist into next year. Everyone along the supply chain feels the cost awakening in Brazil. Large roasters like Nestlé, Starbucks, and JDE source substantial volumes from Brazil, so rising beans squeeze margins unless price pass-through occurs. Coffee importers, grinders, and packaging companies adjust sourcing maps, inventory hedges, and labeling for sustainability claims. Smallholders and cooperatives face credit pressures, higher fertilizer bills, and climate risk, threatening livelihoods and rural communities. Investors in commodity funds, exchange-traded notes, and ESG-focused blends recalibrate risk premiums. Consumers notice at the register as premium brands raise prices and promotional offers shift toward loyalty programs. The ripple extends to logistics providers and local banks. Geopolitics and macro forces shape the cost of coffee beyond farm gates. Brazil navigates an inflationary environment, tax changes, and export incentives that influence planting cycles and credit access. In currency terms, the real swing adds or subtracts affordability for importers and exporters alike. Global demand patterns matter too, with rising middle-class consumption in Asia and Europe. Energy prices, transport costs, and policy shifts on biofuel blends contribute to the price of logistics. Weather risk in other coffee-producing regions, coupled with El Niño forecasts, keeps price risk elevated while central banks recalibrate stimulus and inflation targets. Supply lines tighten as ports face congestion. Smart money is positioning for continued volatility as a climate-aware, value-driven macro story. Hedge funds tilt toward relative value across origin and processing names, buying on dips in coffee futures and discounting short-term harvest risk. Large asset managers add covered calls and longer-duration hedges to tame drawdowns. Retail-oriented platforms see rising interest in thematic funds that emphasize sustainable sourcing and transparency. Banks adjust credit lines to farmers while exporters hedge currency and freight rates. The message from the smart money is not to abandon exposure, but to diversify across futures, equities, and real assets carefully. Every story has a bear case, and this one is not simple folklore. A prolonged drought in Brazil or a new coffee leaf rust outbreak could tighten supply further, triggering more price spikes that erode demand rather than expand it. A sharp real appreciation or a global recession could curb imports and keep producers locked into debt cycles. Logistics failures, port congestion, and energy shocks would add costs that no hedging can fully cover. Persistent low yields in origin may awaken new substitutes and intensify consumer price sensitivity. In worst case, a stampede towards substitution erodes premium brands and premiumization fails. Retail investors can navigate this story with disciplined steps rather than chasing headlines. Start with diversification across related assets such as equities of coffee producers, commodity funds, and currency hedges rather than a single event. Consider quality, not just price, by evaluating company margins and sourcing practices behind the brand. Use staged entry and low-cost averaging to cope with volatility. Look at producer cooperatives or impact-focused funds that favor sustainable economy and farmer resilience. Finally, monitor weather outlooks and policy shifts that could tilt supply curves in any given season. Avoid overconcentration in any single market and heed liquidity considerations. Outlook: the true cost of Brazilian coffee will keep unfolding as climate, policy, and consumer behavior intersect. If harvests surprise to the upside, prices ease and margins improve. If drought returns, prices spike and inflationary pressure ticks up globally. Investors should stay vigilant about origin risks, currency moves, and freight costs while recognizing the sector's potential resilience through brands with durable pricing power and transparent supply chains. The call to action is to learn the story behind a cup and to engage responsibly with investments that reflect both risk and opportunity. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.